Welcome to the Making Money in Multifamily show, where we discuss everything to do with multifamily real estate investing. We believe it's the best way to gain financial freedom and build lasting wealth. This is where you'll find the best information and practices to help you succeed in your real estate business, whether you're already experienced or just starting out. Here's your host, Dave Morja.
Hello, listener, and welcome to the show. I am your host, Dave Morja, and with me today is Anthony Vicino. Anthony, welcome to the show.
Thanks for having me, man. It's good to be here.
Yeah, I appreciate you coming on, and just wanted to give the listener a little bit more of your background before we dig in. For the listener, Anthony is a serial entrepreneur. He has helped build multiple million-dollar businesses from the ground up. He is a best-selling author, investor, and small business owner, and he has a just great multifamily background before he partnered recently with his partner, Dan Kruger, in 2019. They formed Invictus Capital. Since then, him and Dan have formed a podcast. They've authored a book. The podcast is Multifamily Investing Made Simple. The book is Passive Investing Made Simple. So just a lot going on, Anthony. And yeah, we kind of talked before the show, kind of a little more color in your neck of the woods lately. Couple deals closed and quite a bit of, I guess, legislation going on. So you just want to kind of give us your background and maybe we'll kind of dig into that topic today.
Yeah, so just real high level, we are a vertically integrated multifamily acquisition firm in the Twin Cities. And it's funny, I always say Twin Cities, and it's been pointed out to me recently that people who are not from Minnesota do not necessarily know what I mean when I say Twin Cities. So, so for those that don't know, like our baseball team is the Twins. So I just kind of assumed everybody knew that, like, that's why. But Minneapolis and St. Paul, those are the Twin Cities here. And that's where we invest. Like I said, we're vertically integrated. So we got property management company in-house. We manage our assets and we love our backyard. It's our home field advantage. But right now, in the last couple of weeks, rent control has been a hot topic and it got voted in St. Paul, and it's potentially going to go into effect in Minneapolis. And so what that's created is a little bit of a shifting of the rules of the game, so to speak. And so we're just adapting and pivoting and still thriving. So, but it's interesting times for sure.
Yeah, appreciate that color in the background on that. And one thing that struck me as we kind of talked before we hit record was you mentioned the confidence that you had with your investors going through these deals, even with these hurdles in your way. So do you want to kind of just maybe highlight that for a second, what it takes to make those relationships? Obviously, the confidence ultimately ends up back to you and your partner, right? It's are you guys going to perform? So maybe just kind of highlight how you've strengthened those relationships to make sure that they know you're going to close and continue to perform on these deals no matter what kind of comes your way.
Yeah, that's exactly it. Like, for context, the rent control measures here in the Twin Cities got passed last Tuesday, and that was poor timing because we just opened up an investment opportunity to our investors this week later. So that was still like hot in everybody's minds, and we're like, well, how are our investors going to respond? Because it's one thing to say, oh yeah, I'll invest in your next deal, but to actually put the money in is another thing entirely. And that deal, it was like $2 million capital raise in less than 48 hours. So the investors came through in a big way and said, we have a lot of confidence. And we had investors reaching out personally and saying, listen, like, we think that there's a headwind here. It's going to be harder for you guys to operate, but we have confidence in you and your team. And I think that's from a couple of different things. One is we're never afraid to point out what the issues are. So we don't sugarcoat things and pretend like multifamily is just going to go to the moon and it's perfect sailings all the way. Like, we acknowledge that to make money sometimes, like, it's going to be difficult. And our job as operators is to solve problems. So it's not just to point out the problems and say, woe is me. It's to say, okay, here's the issue. Here's what we're going to do about it. And we've just built up enough of a track record at this point over the last 7 years with our investors to be able to say, okay, when the times are good, these guys are exceptional. When times are bad, they're still exceptional. They don't put their head in the sand. They communicate openly with us about what's happening and what they plan to do about it. And it's the number one rule for passive investors is, like, don't invest in the deal, because the deal is it's just spreadsheet and numbers, right? And numbers don't lie, but I can make them say whatever I want them to say. So if you can't trust me as the operator, my numbers are no good. So it all starts with the jockey, like betting on the jockey, not the horse. And at the end of the day, the reason that analogy is so important is because a championship level jockey isn't going to get on a lame horse, right? Tom Brady didn't leave whatever. I'm not a sports guy, so I'm probably going to get this messed up, but he didn't leave whatever team he was on and go to a team that he didn't think he could win with, right? Like he went to a team and he's like, I can win with this team, right? And so when you bet on the jockey, they're not going to get on a lame deal. And that's really what our investors were saying to us is like, listen, we know that there's some steep competition out there now. There's other horses in this race, but we still believe in you and the horse that you're getting on. And so that was great. That was really good confirmation for us. And and now comes the fun part, which is actually going in there and doing the work. And like, we have $30 million of assets spread across the Twin Cities. So we're very familiar with this market and we're still confident in it. So it's not just blind faith. There's a little bit of a track record there. So that helps.
Yeah, and I'd love to get into kind of the, communication with investors and how you're going to look forward to operating this property. But just to take a step back for a second, can we just shed some light on, the recent news in the Twin Cities and how, I guess, economically that may affect things looking forward? And I guess maybe we'll just kind of lean into how you're communicating with investors with all these things kind of coming at you.
Yeah, so there's two questions there. One is rent control generally, and then the other one is communications specifically. And so the communications is easy. Like as soon as this legislation passed, and we've been communicating with our investors through our newsletter and through phone calls in the months leading up, because this doesn't come as a surprise to anybody. We all knew that this was a potential, like it had been in the news. People have been talking about it for a long time. And so as soon as it passed, 3 days later, we held a live webinar for the entire investing community, but specifically for our investors to come and hear from our mouths what had happened, exactly what the legislation was, and what we were going to do as a result of that. And we even went to a further step, which was we went back to all the deals that we currently have in process, and we re-looked at the numbers and plugged in the new assumptions and said, okay, here's what's happening with rent control. Let's say our entire business model is now in this new paradigm. What's this going to do for the returns? And so we were able to come to our investors and say, we've run the numbers with the new situation. Here's what it looks like. And in the grand scheme of things, it didn't shift things in a meaningful way because there's always opportunity, right? There's always another way to find the value. And so that's just what this forced us to do, was to find other ways outside of rent to find value. Rent's always the easy one, but it's not the only one. Now, rent control specifically as like this macroeconomic concept, it's a bit of the boogeyman for multifamily investors, especially value add, because they look at it and they're like, well, if I can't raise rents, what am I going to do? But if you look at it across most markets like San Francisco, Seattle, New York, usually it's some kind of nominal increase pegged to CPI, which is inflation, let's say. So I think in San Francisco, it's 7% plus CPI. In Seattle, it's like 5% plus CPI. So if CPI, let's say inflation is 3 or 4%, and that's a whole other boogeyman question, right? Like, I don't want to go too far into the rabbit hole of
we
inflation.
could be talking for hours today.
Yeah, exactly. But let's just say it's like 3 or 4%. Well, in Seattle, it's 5%. So you can raise rents up to 8% per year. And in San Francisco, it's 7% plus that. So about 10%. And what we looked at is like, okay, historically, we have never projected north of 4% rent, organic rent increase per year anyway. So like, we're never going to be in jeopardy of that. Now with the value add component, that's where things get trickier. Is you go in there, you do the work, and like sometimes you're raising the rent by 15, 20%. And in those markets, there's this nuance of rent control called vacancy control, which is when tenants leave, they can reset their rent to market, right? And so if you get the tenants to leave and you go and do the renovations, then you can raise the rent to whatever you want to the new market standard. And then for that new tenant, it's going to be pegged. Now, I mention all of that because in all cases of rent control, generally, it doesn't really affect good operators. What it does is it affects the people who want to gouge and just like drive up rents 15% without doing any value add. Like realistically, though, it's not a big issue. Now in St. Paul, where they passed the legislation, it's interesting because what they did was they looked back and said, okay, over the last 20 years, what has been the average rent increase in St. Paul? And they said, oh, it's 3%. So they pegged it to 3%. They didn't put it on top of inflation. So it's just 3%, which doesn't necessarily keep pace with inflation. So it's a very problematic ordinance. On top of that, there's vacancy control. So you can't raise the rents between tenants either. So what they did in St. Paul was they put a very draconian policy into place that makes it incredibly difficult to operate. There's still ways, but it's difficult. In Minneapolis, they didn't actually pass rent control. What they actually did was they just gave the city council the ability to enact rent control in the future. But the city council is actually very moderate and very against rent control generally, and the mayor is as well. So it's unlikely that it's going to get passed there in any kind of meaningful way. So all that's to say, rent control is like generally, I think, kind of misunderstood from both sides, both the investment side and saying like, actually, in most cases, it's not really going to hurt your investment. If anything, it puts more of a crunch on the supply side of things, which is usually good for cap rate compression. You're going to make up the value on the back end. And it's really definitely misunderstood by the general population who thinks it's the solution to price gouging or to nefarious landlords taking advantage of their residents, when in fact, what it does is it puts more of a constraint on the supply issue, because what we do know is when rent control goes into effect, landowners generally convert their apartments to condos. So more supply goes off the market, builders stop. And so there's just even more of this crunch. And so the people that are trying to be served, and this is the unfortunate part, is like, I do agree, like there's people not being served. And the question of affordable housing is a real concern, because you can't build affordable housing brand new. It just doesn't really work without government subsidy. But unfortunately, this doesn't really solve the issue. So we still have people who are not going to be well served. So that's a long answer.
No. That's perfect. And it's interesting you talk about that kind of slippery slope, right? And I don't think you compare any market to where I live, but here in New York City, is kind of, people think rent control, they think of a New York or like in LA where there's, high rent costs and people are that their rent to income ratio is like totally skewed and everything's about, kind of getting the landlords and not really focusing on landlords' rights, which is an entirely different conversation if we're going to be talking about different conversations. But it's just interesting to kind of see the first steps for a new kind of metro, taking that plunge in St. Paul there. I think an advantage that you didn't really touch on, but having a kind of economical advantage where you guys are vertically leveraged or someone with experience already in that market, there's a lot to be said there, because you talk about adding value while not focusing on rent. You're talking about reducing expenses and all these other kind of vertically integrated tools that you can use to kind of take advantage of something that might scare a lot of people away. And just kind of like you mentioned, supply might go down, but also investor interest might go down too in that market, right? So you might actually find more opportunities here in the next coming years. Who knows? But for you, if you're going to stay put, it could actually end up in some form or fashion just kind of turning honestly into a bigger opportunity. So what do you kind of see for the next couple of years for you guys in these two markets? I assume you're going to be there, right? So what is your kind of game plan moving forward? Obviously, a lot of communication with investors and continuing to look. What do you think is going to be happening there?
Well, you nailed it on the head. Is like the fact that we're local and this is our home field is that we have a unique edge. We know the ordinances, we know the locations, we know all the people involved, and more importantly is that we're the active operators, so we can control a lot of the expenses. And so that gives us a unique advantage. And we're going to lean into that. And we're seeing a lot more deals actually coming onto the market right now, because a lot of landlords and owners are like, I don't want to deal with this. They don't have the wherewithal or the energy, or they might have already made their money and they just want to cash out. So we're seeing a good buying opportunity, if nothing else, right now. And one of the really interesting things is when you look at rent control, what it actually ends up doing, because it takes, again, more supply off of the market. And that's a good thing when it comes to owning assets, right? When there's less supply, but a lot of demand, those assets become more valuable. Now, we can't realize that value through cash flow because there's the rent cap. So we're not going to be getting like crazy cash flowing assets. And that's why you don't invest your cash flow in New York or San Francisco, for instance. But you do get a compressed cap rate, which means on the back end, these things are selling for more. So it kind of washes out in a lot of ways. Now, all that's to say for us, like St. Paul, the ordinance there is so draconian that we're not going to purchase in that market until they get that sorted out. Because there's a couple other nuances of that protocol that are really, really problematic. And they're going to change it. They're already trying to walk it back. The mayor and the city council have already said it's not feasible, and it got put onto the ballot. This is really interesting. A unique quirk of St. Paul law is that any resident can propose a referendum. And that's what happened, is like a group of residents, like citizens, got together, put this referendum on there. And it wasn't like part of some think tank economic advisors or anything like that. It's like, yeah, they're like, let's do this and this and this. And it was like, and then, rent control for the general population, they look at it and like, yeah, that's a good thing. And they, and it got passed. And now everybody's looking at that. And it's like, just in the last 3 days, 3,000 units of new development that are currently in process got pulled off market. And so there's this crisis of development that's happening there now. So it's like, okay, this isn't going to survive in its current paradigm, but we're not going to buy in that environment. The current assets that we own, they're well past that value add component. So we're not worried about them. They're going to continue performing even at 3% rise. But we're going to focus on Minneapolis, where people see the doom and gloom across the border and they're like, oh, that's coming over here. Let's get out while we can. That promotes an opportunity for us to go and buy. And even then, what we're doing is looking into the first ring suburbs around the Twin Cities, right? Because what ends up happening is, well, if there's no development, so to speak, and there's limited supply in the cities, where are people going to go? They just get pushed further and further out. So there's going to be more opportunity in the first ring suburbs. And so we're starting to turn our attention there. We've put a pause on St. Paul, but generally, like, we still love the Twin Cities, because if you look at it from a macroeconomic perspective, and that's always the first and most important thing, is like, what's the job situation? What's the median income, median household income, price of rent versus owning? And we look at all those factors and we're like, this is still a really strong market. It's the socio-political angle that's causing some kinks in the system, but it's still from a, can there be money made here perspective? Yes, the answer is definitely yes.
Yeah, and you mentioned putting a pause on St. Paul, which I think probably makes sense, right? If you're talking about return on effort, you're not going to really try to look for a market that is going to be pretty much challenging for at least the next, year or whatever until they figure it out. But kind of a challenging question, and there's no really right answer. But what would, if a deal fell in your lap, kind of entice you to look there, regardless of the hurdles that may be there? Like, say, a broker comes with an off-market deal, like, listen, I know you're not looking, but this one's a kind of a dinger. So what would that be to you?
That's a good question. We do a lot of deals with the old guard. So these guys and gals who've been in the business for 30 plus years, and they own a ton of inventory here. And so we do a lot of off-market deals with those guys. And one in particular, he has about 250 units in St. Paul and Minneapolis that he's looking to offload. And we've been picking them off for him slowly but surely over the last year. And the conversation we've had with him is like, listen, it's all got to be on the purchase price. Like, that's the only way that we can justify this, is that we have to go in with a lot of baked in equity already, because we're not going to be able to realize it through the cash flows. And we're going to be needing something that's very stabilized already, right? Because the incentives for going and doing heavy value add renovations, it's so low, especially in an environment where it's already hard to get labor and materials. And so we would need something that, has the value add in terms of like, oh, we're buying this at a discount, without actually having to do the value add.
Yeah, that makes sense. I mean, you talk about how many units could you realistically turn, especially, in a market where people are going to start to learn, if they sit tight, they're going to have cheap rent forever. So the actual transactions between renters is probably going to change pretty quickly, and probably shorten real quick, and there won't be as many people moving, just because they know if they stay, they can sit on their lower rent. So yeah, I just figured that was a kind of interesting little thought exercise to see where your head would be at there.
And another thing to think about is, when something changes, you always have to have your head on a swivel and think, okay, and given this new environment, what would work? And generally with rent control, what ends up happening is it's usually capped to like Class B, Class C assets of a certain age and vintage. So you end up seeing like people just moving to new development, right? Because if there's no cap on luxury apartments, then let's just go build something, create value from nothing, and sell that thing, where the rent control is not going to affect it. And so that's a plan that we were looking at specifically in St. Paul. Is like, okay, worst case scenario, we have all these buildings are old, because that's the case in Minneapolis. St. Paul is like, we have old inventory. We'll just go knock those down and just build something new. And then it won't be an issue. We'll just have this new building. but but one of the interesting consequences of this particular rent control ordinance, and I said like they just kept like dinging it with every crazy thing possible. They actually applied the rent control across the board to luxury units and new builds as well. And this is why the developers pulled thousands of units. They're like, well, wait a minute. Like there's no,
What good
like,
is
why
that
are
to
we
us?
building?
Yeah.
Yeah. And,
We're a
and so
development
it's like,
trying to make big returns here, because there's a lot
yeah.
of risk. What's the point if we don't get a big return?
So
Yeah.
yeah, and so the mayor even came out and like was publicly like, he's like, for the life of me, I can't understand why we would put a rent control cap on luxury new builds. He's like, so this plan needs to be reworked. And so, that's all this is. I think some things are going to change in that plan. It's not a well thought out one, but generally, even if they put something just more moderate into place, like it, I think rent control gets such a bad rap in terms of like, oh, it's going to handcuff us and it's going to be impossible to operate. It does become harder, but there's still a lot of opportunity.
Yeah, no, it sounds like the buy right is pretty much the only opportunity there, like you're saying. So interesting to hear your take. And I guess let's flip it. Investors' take on this whole thing. How has those conversations been? What are people saying? Obviously, the trust is still there with you guys. So, what are the conversations involved around the actual kind of market and the news involved, and their just takes on the two cities, I guess, in general?
Yeah, I think with the investors, one of the conversations that we had the other day, which was interesting to me, was he's like, I'm going to invest in this deal, but just so you know, like if you guys went to a market that didn't have the headwinds, he's like, we would put so much more into this, and I was like, oh, that's interesting. So like, there's definitely, I think, why make things harder on yourself than necessary, right? There's a little bit of that angle, and that's a question that we have to resolve for ourselves right now in Minneapolis. It's not any harder than necessary because nothing's actually been passed there. St. Paul, we pumped the brakes because it's like, yeah, that's harder. So that's a question, and honestly, the problem though is when you go chasing opportunities of like what's easier, where there is enough tailwind, then you just end up doing what everybody else is doing, which is like playing outside of our unique advantage. And so maybe that's going down to the sunshine states or the smile cities, right? Like, okay, we're going to go invest in Phoenix or Houston and Nashville, places that have a really strong tailwind. But as a result of having that really strong tailwind, they also have a lot of competition. What we can look to here, and I think this is what our investors are betting on with us in particular, is yes, there's more headwind, but as a result, there's less competition. So we have more room to play. And I think that's where our unique advantages will really play out on a long scale.
Yeah, and if you're talking analogies, you're pretty much just building a more efficient airplane to get through that, right? Like you guys vertically integrating, it's just being able to cut through that wind a little bit more cleaner than someone who isn't as familiar. And that's, like you said, the unique advantage there. So, yeah, I guess argument for both. Is that anything you guys actually ultimately consider, or are you guys just firmly in that market for the time being?
Well, like I said, we're expanding our reach into the first ring suburbs, which is new for us. Like,
Yeah.
and honestly, the way that the cities are laid out, it's all arbitrary. Like they're all right next to each other, and so very close proximity. We've always just stayed in Minneapolis, St. Paul, because from an efficiency standpoint for our property management team, it was just so much easier to have them hyper located in those areas. And so just even moving, or say, into Bloomington, which is just down south where the Mall of America, and like we have more Fortune 500 companies by per capita than any other city in the country. Like that's why, like they're all right there. It's only like 10 miles away, but 10 miles in rush hour can be really hard for property management. So we've always wanted to look into the suburbs, but it's got to be within enough initial scale to justify opening a property management hub down there, and having enough work for the maintenance and repair construction team to keep them busy for extended periods of time. And so we were playing a little bit slower role, I think, in like how the timeline in which we thought we'd move into those markets. But with everything that's changing now, we're like, okay, well, now's the best time to actively pursue what that transition would look like.
No, and obviously it sounds like pretty good timing right now, right? The cards are kind of falling in the right direction. So what about this whole process? Because through COVID, I think there's a lot of learning lessons because it's a big catalyst. A lot of investors and sponsors learned a ton about themselves, about deals, about each other. This is obviously a much smaller scale, but it is a catalyst and it's just a certain market. So what was the kind of biggest learning, not necessarily that you have to change your underwriting or X, Y, and Z, but what was like the biggest learning through this whole thing that kind of has made you guys move forward quicker than you expected?
Can you explain that a little bit better? I'm thinking, are we thinking COVID or rent control?
More the rent control, yeah. Yeah,
Um,
what was kind of more just like the short, a lot of times with Catalyst, there's a short of a learning curve, right? So what would you pin
mhm.
that as for the rent control?
um, I think with rent control, we've had a really long runway to kind of like unpack it. And so we've been baking a lot of the assumptions of rent control into our underwriting for the last year anyhow, and saying like, okay, if this does happen, what would it look like? So we're kind of prepared from that perspective and really looking at, what are the alternative ways that we can derive value from these assets? And I think, like I mentioned before, rent's always the easiest one. It's the sexiest one because, like, we always remember who scores the most points in a basketball game. We don't remember who blocked the most balls usually. So,
Yeah.
like, defense doesn't get the love it deserves, even though defense wins championships. But like the most valuable lesson I had a mentor in my very first business who said, remember that a dollar saved is worth more than a dollar earned, because the dollar earned is always on a margin, whereas the dollar saved always goes to the bottom line. And that was a really impactful lesson, because for every $1 that you raise rent, you only get to keep 58 cents of that to your bottom line, assuming you're on a 50% expense ratio. Maybe it's 42, maybe it's 40, I don't know. But still, like, you're not keeping the full dollar. But if you can cut a dollar of expenses, you get to keep that full dollar. And so I think this time, especially with rent control in the last year of COVID, as we're like, well, maybe raising rents isn't the humane thing to do to people right now. Like, what are the other ways that we could improve operational efficiencies? Not cutting corners so that our assets are like slowly deteriorating or becoming slumlords, but how can we run a more efficient operation with better systems that scale so that we can cut those expenses? Because at the end of the day, it's easy to say we're going to cut expenses by this much. It's a whole other thing to go in there and actually do it. Like, you have asset management experience, and so like, it's one thing to say this is the budget. It's a whole other thing to actually hit the budget.
Yeah, no, it's interesting. I think you nailed it pretty well. It's like you said, kind of back at the beginning of the show. It's not just numbers on the paper, right? There's a lot more intricacies and kind of soft skills and everything that goes along with it to be able to kind of put the business plan in place. And it sounds like there's a lot of moving parts, but you guys, I'm sure, are going to be navigating through this, I'm sure, with some form of ease. So appreciate you kind of bringing in your insights to this, Mark, which I don't really touch on personally. So it's interesting to hear someone who's in it deep, their take on it. But I would love to get into these 5 key questions, Anthony, as long as you're ready.
Yeah, let's do it.
So the first one is, if you could only pick one trait that explains your success, what is that trait and why?
Hyper focus. So, and I think when people say hyper focus or focus, that means a very specific thing to them. But for me, I have severe ADHD, and it was actually very problematic when I was young. And when I say young, I mean like all the way up until I was like 30, until I really figured out how to create systems and habits and routines around my life that would allow me to succeed. But one of the unique consequences of ADHD is that I think a lot of people think it means that we can't focus, but what it really means is that we can't always control what we're focused on. And so when we are focused on something, we go into what's known as a hyper focused state. And this is very similar to the flow state, but a little bit different. And it's the reason why people with ADHD will literally sit in a burning house while playing video games. Like, they just won't notice. They'll just lose themselves in it. And for me, the hyper focus trait was very problematic when I was young because I couldn't control it. And I would like play video games for 10 days straight. But once I figured out how I could use it as a tool, it stopped being a weakness and it became a super tool, because now I can get into this state and maximize my productivity, so to speak, like in a very short amount of time. So that's been very helpful.
That's super interesting. Don't hear about that a lot. Appreciate just kind of transparency, because sometimes I get good answers, but that's one of the ones where it's like, wow, that's like a real answer. So I really appreciate that.
Thanks. Yeah.
Yeah. Sometimes I get, like I work too hard or whatever. It's like, no, okay. Yeah.
I'm a workaholic. I
Yeah.
care too much.
Yeah.
I interviewed a guy yesterday and I was like, which I always say, I don't say what's your weekness. I say, what's your kryptonite? And he goes, I work too much.
Yeah.
Or no, I care too. He said, I care too much.
This is an
And I was
interview, but
like,
it's not a job interview. So
yeah.
yeah. And then Anthony, what is the most uncharacteristic thing you've done in your business, and why did you do it?
So I don't know if it's uncharacteristic, but I believe two things. One is that who's ever closest to the consumer wins. And this has been a guiding tenet in all the businesses that I've built, which is let's cut out the middleman, control as many aspects of the process as possible. And that's why we started building property management from day one. Now, the thing with that is you can only ever hire at 2 points. You either do it too soon or too late. Like nobody's ever hired at the perfect time at the right moment. Like, so you're either paying too soon in the form of money, or you're paying too late in the form of opportunity costs. And I always choose pay money, never opportunity. And so we started building property management before it financially made sense. Like it was more expensive than if we had been outsourcing it for the first couple of years. But then it hits this inflection point and it's so much better as a result.
Yeah, and that's interesting. I think with that, you can gain a little more control, like you said, over those few years, right? And kind of rub out the mistakes before they were bigger mistakes. If you had, something on a 20 unit property, you could fix it. And then if you're running a 200, it would be obviously a much, much bigger headache to fix those systems at that scale. So interesting to hear that take.
Yeah. And I get the question a lot from operators who already have a nice portfolio. They're like, oh, we're thinking about bringing property management in-house. What would you suggest? And I'm like, I have nothing for you. I don't know. Like, because transitioning a portfolio into in-house property management is very different than from day one building it. So different strokes.
Yeah. Maybe buy the right company and hope for the best,
Acquisitions are a very real avenue to growth.
Yep, absolutely. And then can you name a time where you felt like you weren't going to end up successful, and how did you overcome that fear?
Well, there was a time wherein I was $80,000 in debt. My fiance had literally just left me, kicked me out of the house, and I was living in the back of a van in downtown Oakland. And it's interesting because I had never really stopped to think like my life isn't going how I thought it was going to go until that moment. Like that was a real wake up call to be like, all right, maybe I'm doing something wrong. And that was a good thing because then it gave me a perspective from which I could start moving forward and saying like, I need to have not just a goal for where I want to go in life, but I need to figure out how I want to get there. And up to that moment, I really hadn't been doing that. I've been letting my ADHD just kind of own my life. And that was really the catalyst, the turning point where I said, okay, it's enough. It's time to take control of my biology and no longer let that be an excuse. It's time to use this to my advantage. And that was really the pivot point.
No, that's amazing. And then pretty much opposite to that one, can you name a time where something in your business went perfectly, and what did you do to make that a reality?
Nothing ever goes perfectly.
That's my popular answer right there.
Yeah. And I don't want to cop out. So I will say this. It doesn't go perfectly. But I am surprised how having a bias towards action almost always inevitably plays out favorably, regardless of how half-cocked the idea really is. Like just moving forward towards a goal and saying, hey, this is a new product, we want to take it to market, and just doing it before you really overthink it almost always plays out advantageously. And that has been a hard lesson for me because I'm not that type of guy. I like to be a little bit more planned and organized. And I've been blessed to have some really great business partners who are more the chaos to my order. And they push me to move faster towards things. I'm like, that's not going to work. This is half cocked. Like, we're not ready. And it works. I'm like, all right, well, that's cool. Lesson learned.
Yeah, I think honestly, one of the most popular answers to my first question, or the one trait, is kind of the action or failure to, stop moving, is not fearing failure and just to keep moving. And right there is it, man. It's like you can figure out systems until you're blue in the face, red in the face, but just keep going, and you might not find the most efficient way, but eventually you're going to get what you want if you just keep taking those steps. So yeah, I couldn't agree more. Then last one, just to wrap up the show. Oh, go ahead.
No, go ahead. No, go ahead.
And then last one, just to wrap up the show, Anthony, what have you been focusing on lately to improve yourself or your business?
I've been focused a lot, I would say in the last year, on what I talk about as the psychology of presentation. So really thinking about, so I believe that there's 4 spheres of influence that if you could just control those 4 things, like you're going to be doing pretty good. And they're mindset, health, wealth, and communication. And communication always throws people off, like, wait, I understand mindset, health, wealth, but why that one? And communication is important to me because it's like, we all want to be understood and we want to connect with the world. And there's nothing more frustrating than having like greatness or an idea inside of you that you just can't get people to see or move towards. And you just feel like an idiot. And you're like, why don't you guys get this? And so that's a failure of communication, whether that's through writing or through spoken word or through body language or just through your ability to listen, like, because that's a form of communication as well. Like, I've been really fascinated this year with how do I improve as a communicator, and thinking about the psychology of presentation goes very, very deep for me, from like, how do we phrase, which words do we use at what time, what tonality do we use, how do we show up physically with our body language or how we dress. Like, I've been really fascinated with that. And I have a master's degree in psychology, so it's not like super out of the ordinary for me to like be super fascinated with this, but that's the thing that's been really on top of my mind this year.
Yeah, I was going to say that lines up a lot with like psychology and a lot what you would get from like therapy or psychiatrists, kind of just like the intentional conversation, like intentional voice, like, say what you mean in the correct way, and you'll kind of get more dividends on their conversation. So really interesting stuff.
So yeah, when you mentioned intention there, yesterday I made a post. This was like, somebody said this. So his name's Patrick. I can't say his last name, Monteglou. He's a French tennis coach, and he's sitting there with his tennis athlete, and they're talking about intention is a muscle. And I was like, wow, that is actually a really profound concept, but it's true. Like, intention is a muscle. And so moving through life and understanding what's your desired outcome with every activity that you go into, it's a really profound insight. So I just want to share that.
No, I think that's true. It's like, there's times in your life where situations are, more on easy mode, where the intention is easy to output, but then difficult conversation situations, etc., it might be hard to stay intentional in those moments. So that's when like the training to get the muscles to do the things that they're supposed to do kicks in, right? So yeah, that's really, really interesting. Anthony, really appreciate the time. The takes on your market and how you're going to just navigate these waters, good, bad, or ugly. And it sounds like it's going to be good for you guys. So excited to hear how you guys do. Digging in deep on the end here with all the kind of mindset stuff. Just really appreciate the time. Before we hop off, do you want to just let the listener know how they could reach you today?
Yeah, I mean, if you want to invest with us up here in the Great North, after everything that everybody's heard, they're like, no, I'm good. But come find us over at invictusmultifamily.com. So we just published a book back in what was it, August. It hit #1 on Amazon. So that was really cool. So if you want to learn more about passive investing, that book, you can go pick it up for free. All you got to do is pay for shipping. That's at thepassiveinvestingbook.com. And otherwise, just find me, Anthony Vicino. If you Google my name, I will pop up. I'm pretty much the only Anthony Vicino in the world. So reach out. I'd love to communicate and have a conversation.
Anthony, thanks once again. Really appreciate it. Thank you for listening to the show. I don't take your time and attention for granted and appreciate that you would spend it with me. If you enjoyed this show or any of my previous shows, it would be a huge help if you would rate and review the show on Apple Podcasts or your favorite podcasting service, or even just share the episode with a friend. And if you'd like help from me or would like to talk about real estate investing further, feel free to visit the show notes for more information, or you can visit davidtravis.com.